I'd love for you in your own words to tell the audience a bit more about yourself and what you're up to these days. So maybe I'll start with you, Amy, if you don't mind providing an introduction.
Sure. My name's Amy Ray. I'm a partner at Vantage Capital, venture firm here in Vancouver. We are investing at a fund 3, so we have a $110 million fund, and there's 3 themes that we go after. One is hard technologies, so technologies with IP wrapped around it. A lot of times that's software and hardware together. Analytics, we've been doing analytics for quite some time across fund 1, 2, and 3. And third, we're dipping our toes into a little bit in fund 2, and now again more in fund 3 is computational biology. So I'd say we're stage agnostic, though for those of you who know how venture works, we have 5 years to do investments, and it's a 10-year fund. So as we go on in our portfolio, we tend to do later stage investments, but earlier in the portfolio life cycle, we'll look at, seed and pre-seed. So we care a little bit more about the themes than stage.
Awesome. Thanks, Amy. Justin, over to you.
Thanks, Erica. So I'm Justin Young. I'm a partner at Osler. I'm based here in Vancouver. As Erica said, I've been doing this for just over 20 years, and I've been in BC for the last 13 of those 20 years, and working with Amy and Rich and the local community on lots of technology transactions, both locally and internationally. I'm a partner at Osler, as I said. We have the leading venture practice in Canada, and just some of the stuff we're going to talk about today is informed by the work we do internally to sort of track the market and the data that we're seeing. So last year we published the only proprietary data study in the Canadian market, which was our first Deal Point survey, where we looked at close to 400 venture deals, sort of seed to Series E or onwards, covering about $6 billion worth of transaction value over the last 3 years. And we were able to aggregate that data and really get a good sense of what was happening in the Canadian marketplace across the deals that you'd be seeing and hoping to do. So it's really interesting to see that actually gathered from a Canadian perspective. Obviously, we all have access to more US deal flow, but this is a real local Canadian look. We're close to publishing our new report for this year. So if we did this session again in about a month and a half, I'd give you some hard data once we've done all the aggregation. But I have a sense of where the market is, and I've had a sneak peek at some of that data. So it's really interesting to see what's happening in the local landscape, and not only just here in BC, but also across the country. So look forward to chatting with you all today.
Awesome. We're getting a bit of a sneak peek today, it sounds like. So that's great. Rich, over to you.
Yeah, I mean, I think of it, commend Justin and Oslers for doing that. That's a huge service. Data is always scarce in Canada, so hats off to you guys. So unlike most people probably on this call, I don't have a full-time job, so I have to think of creative ways to explain what I do. So I think maybe the simplest is on the seed stage. If you think about kind of companies' stage of maturity, I'm an investor in I don't know, a dozen or so seed stage companies. Some local ones folks may know: Lifestyle RX, Impro.ai, Ecoation, a number of things kind of through CDL and other things I'm involved with. At the slightly more mature phase, call them maybe Series A, B, and into growth, companies like Pocket Pills and Clue. I'm on the board of 2 companies, which has been a really interesting ride, kind of from seed to almost Centaur status. If you know the new acronym, that's $100 million revenue businesses. So League and AlayaCare, 2 healthcare companies I've been fortunate to be part of. Alita, which used to be Vision Critical, locally, been on the board there, or was on the board there for a long time, and an investor. And then kind of at the far end, call it the most mature, and I'm an advisor to a new fund called Roller Labs, which is started by Canadian Tire to kind of reinvent retail. And I'm also on the board of something called Nicola Wealth, which does investments in funds and in companies. And I'm an LP myself in funds like Georgian and Union Ventures and 776 and Bain and things like that. So I've sort of been the entrepreneur and the LP, and then the kind of the investor in the middle, and can't seem to hold down a job in any of them.
And I should mention, you also serve on the BC Tech Board in your spare time as well, and Justin as well. So thank you.
That was going to be my crowning comment at the end. That's the thing I'm absolutely most proud of.
That's awesome. So we kind of teased a little bit, the audience, Justin, you already kind of mentioned it, but we really were hoping to start off by talking a bit about the trends that the three of you are seeing in the market. So, how are they different from what we've seen in the past year and beyond? And maybe Justin, can you give us a bit of a rundown? What are you seeing? And then I'd love to get Amy and Rich to tag in.
Yeah, for sure. I'll happy to speak to that. And sorry, I don't know if I actually mentioned or you mentioned Erica, but when I say I'm a partner at Osler, we're a law firm. So if you didn't pick up on that, we're not a venture VC firm, we're a law firm. So we work with thousands of companies across the country and most of the investors, but that's our particular role in the market. So we're obviously very alive to trends because all those companies that we work with reach out to us regularly to figure out what they're going to do on the capital raising side, and we're involved with the process usually, on an ongoing basis, frankly, because most venture-backed companies or tech companies that hope to scale are raising on a regular cadence. So we're seeing these same conversations sort of quarter over quarter, year over year with the same companies. And it really, obviously, there's been a sea change from the end of 2021 and into the middle of 2022 or the early 2022 when the market started to shift dramatically. And so much of what I think we'll say today probably isn't going to surprise anyone, because if you read the paper or you watch the news or you're just alive to what's happening in your own companies, you're sort of seeing these changes happening. But there is no doubt that over the last 2 years, we've seen an incredible variance in deal terms, both with initially the onset of COVID and the panic that set in originally, which completely reversed course in the venture market and led to the most incredible run of venture finance we've seen in global history over the 2020 and 2021 period. But we've also seen an almost equally surprising and rapid shift in the financing landscape over the last year. So how can we break that down in terms of trends? I mean, the obvious one that I'll start with, and sort of the more gloomier news, is that capital is just harder to raise, period. So if you want to sum up everything we're going to talk about today, that's probably a good conclusion. It's harder to raise money now than it was before. And again, I think most of you know that. What does that really mean? And what are we seeing in actual terms? Valuations are down, again, not just the public markets you read about, but in the private space, we're definitely seeing a shift in how companies are valued. We're seeing a reduction in the number of investors competing for transactions. So often with our clients today, they're fortunate or feel fortunate to have one term sheet, maybe two. If you roll back a year and a half ago, you were often in competing bid situations where you're out there getting multiple term sheets before committing to a financing path. So very, very much fewer investors per deal, longer time periods to closing. And the one that's a little bit hard to track, but that is anecdotally true across our practice, is there's more risk to getting your deal completed. So if you are raising money as a founder, just having a signed term sheet is less likely today to mean that you're going to actually complete the deal than it was a year and a half ago. And I know, Amy and Rich will tell you, as investors, they never want to sign a term sheet they're not going to close on. And so nobody sets out hoping that's, that's going to be the outcome, but we are seeing deals either not close or be retraded and changed substantially along the way, which would have been relatively unheard of a year and a half ago. And then clearly more investor-friendly terms, and that's where I think we'll spend some of the conversation time today. And we can get into a little bit about what that looks like. I have a laundry list of other things. I mean, maybe I'll just cherry pick a couple that can start the conversation without going through all of them. But the big one that I think we can talk about is an increase in bridge financings. And by that, we mean financings that are between your traditional priced equity rounds. So the usual cadence would see you do a priced venture financing if you're on that pathway where you have a priced equity round that somebody leads, and you might do that every 12 to 18 months, depending on your capital needs and your type of business you're running. But typically you're raising on these fixed time periods. And in 21, you might have raised money in between on either a SAFE or a convertible note, not because you necessarily needed the money, but because you had investor interest where people wanted to get in at a better price early and front run a deal. Today, we're seeing those price rounds extended and stretched as the market softens, and instead companies are turning typically to their existing investors to do bridge financings. they're either extending the last round or they're actually doing a new unpriced bridge. Safes have been hot for the last, call it 5 years. We're definitely seeing a move towards convertible unsecured notes and even secured notes on deals, which gives the investor more protection in a debt instrument. And we're seeing other terms come into play like warrant coverage and other sweeteners to these deals, so that not only the existing investors are getting more for their at-risk capital, but they're trying to bring in new money to existing deals with some of the sweeteners. So definitely we can talk with Amy and Rich about the deal terms we're seeing. And that's true across the fixed price equity deals too, that the landscape is starting to shift. One that I'll ask Rich and Amy about is the secondary market. So in 2022, it was a rare deal where we didn't see some of the, from Series A or Series B onwards at least, didn't see some of the existing shareholders cashing out in what we call a secondary transaction, which often made up part of the financing you read about in the headlines. And today, anecdotally, and again, I think you're going to see this play out in our survey results, the incidence of secondaries is decreased to almost zero. So typically now, founders and more frequently early investors are not being offered an opportunity to cash out of companies today, because cash is king, and every dollar that the investors want to put in play is pretty much going to treasury. There are the occasional secondary right now for oversubscribed rounds, but again, it's very few and far between. So, there's a number of other things I think we can get into, but maybe that's a good enough list for us to kick off the conversation with, Erica.
Yeah, that's great. Thank you. Lots to chew on there. Amy, curious about your perspective. If you want to comment on some of the specific, the first kind of thing was capital, it's harder to raise. I'm hoping someone's got some optimism. We're going to use into this session as well.
Yeah.
But yeah, talking about capital raising, bridge financing, and secondary markets, I think was a few things Justin kind of.
Yeah, for sure. I definitely think it's a tough market out there right now, but good companies are still getting financed. I think everybody probably saw Jobber in the headlines today, which was congrats to them. What a great company out of Edmonton. I think they're out of Edmonton. I think that's one of your companies, Justin. And so, yeah, if you have the metrics and you have the growth and, you're good with capital and have a line of sight into profitability, I think you're still getting funded. The bridge rounds, I'd say absolutely so many companies are looking for bridge rounds because they can't go out into the open market. But I'd say the difference with the bridge rounds is everybody around the table wants to see that profitability. So you're going to raise X dollars in cash. Can you get to profitability with that cash? And if you can't, I'm not sure investors are going to put that money in. So that means you're probably going to have to do a RIF, which is a reduce in workforce, which we've been seeing over and over again. The one thing I'd say is the companies who do make it through this and can kind of hunker down and spend so that they can get to profitability, I think there'll be stronger companies for it. I truly do. I think in the past where people were spending money, I think a lot of it was wasted because you're just moving so fast. You don't have time to double back and look at your spend. You hire so quickly. There's no way when you hire, 100 people in a quarter or two that all of those people are great people. So going back and making sure that your bar is still really high for the people internally in your company. So bridge financing, I think most portfolio companies are looking at their portfolios and saying, which ones do I want to double down on? But we're also having those hard conversations of, if I give you dollars, I want to make sure that it's spent properly. I think on the secondaries, I'll comment on that. I don't think you're seeing secondaries. That cash is going to your balance sheet, and that balance sheet is not hitting zero. It can't hit zero right now in this environment. I need to see a line of sight into profitability. If you have cash going 2 years out, that's fine. You can have profitability in 2 years, and you might, things will change, and you can change direction later. But for right now, to get that capital, you have to be able to show something that's really efficient to your investors. So I think secondary, bridge, and what was the other one?
Those are the two, and capital harder to raise.
And capital, yeah. So fair enough.
Yeah.
valuations, Amy, are you seeing that for the, even for, like you mentioned, the good companies are still raising money, and we're certainly seeing that. We've got lots of portfolio companies doing nice priced equity rounds, but
Yep.
would you say generally speaking, that valuations are down on a multiple basis?
I think so. I mean, in general, when you go to raise, you look at the public markets to look at your comparables. And the public markets are usually a lot frothier than the private, and we're sitting in an inversion right now. So you don't want to look at the comps on the public markets right now. I'd even say like you're lucky if you're looking at them this week versus a month ago, right? Like it's looking a little bit better in the public markets. I think the public markets have really been hammered, even, you know, beyond what probably they should be. There's a lot of, especially in Canada, great public companies who are sitting at a market cap that's lower than the cash on their balance sheet. I mean, that's just unprecedented. I think valuations have to be, you know, they're certainly not in the 50 times. I think for the last, I'd say 10 years, we're kind of looking at good metrics, good growth, good management team, good market. You're looking at, you know, 10 times multiple. And I'd say right now we're probably somewhere closer to the 5 to 8. So even below that 10 times where we've been in the past, you know, taking out the exceptions of those 50 times, like, I just don't think we're going to see that again for a very long time.
Rich, your thoughts?
Yeah, I mean, you guys have covered it so well. You know, not a ton to add. I guess I would just maybe highlight to people. So given the two of the three kind of speakers are, you know, venture folks, and then one who works with them, you know, this may be obvious to a lot of people, but there's only one job as a venture capitalist, and that is to return money to your investors. So everything else you do, all the due diligence, all the meetings, all the conferences, all that stuff, it's just noise if you're not delivering value. And just here's a quick stat for those folks, you know, to add some color. If we're not getting exits, we're not giving money back. And in 2021, there was about $800 billion in worldwide exits by venture-backed companies. Anybody want to guess what it was in 2022? 60 billion. So we went from 800 to 60. So all of a sudden, all of these venture capitalists aren't returning checks to their investors. So now, to Amy's point, the investors in us are saying, wait a minute, I want to really understand your portfolio, and I want to really understand where you're putting more money, and I want to really make sure that company is going to get to where it says it's going to go to. So the level of scrutiny everywhere has increased multiple times. The other thing I'd say is you have to look at the stage of companies. In the growth stage, so call it Series C and beyond, that market's pretty much shut, because those people were the ones who were pre-IPO or, you know, kind of imminent exits, investing on that premise. The seed stage has actually stayed relatively healthy and vibrant, and I'm sure Justin's kind of seeing that, you know, at some level too. That there's so much money that's kind of fleeing the later stage and coming and doing seed stage deals. So good news if those of you on the call who are, you know, in the seed or Series A bracket. There's actually been less dislocation both in pricing and in deal velocity and in deal consummation than there is in some of the other markets. So I think that's the good news. But here's the other sobering thought. The cloud index, the Bessemer Cloud Index, which is the public companies kind of in cloud, is down about 55-60%. No exits, values in half. And if you look at one stat, so if you take the top 10% of companies that raised a growth round 5 years ago, their average valuation, this is top 10%. So the median value of the top 10%, which is what everybody wants to invest in, right? Everybody wants to invest in the winners, was about $250 million was the valuation at that stage. In 2021, it was 1.4 billion. So you basically had a 6x, 7x increase in that time frame. Well, that's not sustainable. I think we all know that. So the winners, which are still few and far between, are drifting downwards in value. The exit market's locked. The money is fleeing to the earlier stage. So guess what happens in 3 to 5 years? You're probably gonna have a bubble at the seed stage. And a lot of those companies will not survive. But anyway, those would be some of the trends I guess I'm seeing now. It'll be really interesting to see what the ramifications are down the line.
I might kind of bring it back just quickly to Justin and Amy if you want to comment on Rich's thoughts there, especially maybe on the seed stage.
Yeah, I mean, definitely from what we're seeing on the ground, good seed stage companies are definitely being funded for sure. So it's much harder to get the later stage deals done than it is the earlier stage deals. And the seed stage investors still want and need deal flow. But I would say the general principle still applies that, you know, valuations are not what they were previously, and rounds are harder to get done, but absolutely it's more amplified at the later stage. And I'd be curious for Rich and Amy from an investor perspective, you know, although early stage there's more of a blank canvas to shape sort of how the capital is going to be deployed and how the business model is going to work. And, you know, it's much easier to influence that in the first institutional check. But surely in the back of the mind of the seed stage institutional investor, you are thinking about the company's capacity to raise an A from someone other than you, or a B or whatever, right? So there's going to be a dampening effect there too. Just because, you know, once you deploy that capital, you don't want to have to be the sole source of the next round. So there's a muting effect there, even if it's not necessarily because you're concerned about getting from seed to A, but rather what's going to happen when you get to A. Would you say that's probably true even in the early stage deals?
I'd say so. I'd also say, you know, as an investor, we're a decent sized fund in Canada, but we're a very small fund in the US, and especially tackling some hardware investments, we're a small fund. So part of that is just us mitigating our risk, making sure there's more people around the table with us who have deep pockets with us so that we can all continue to fund good companies. But I definitely think so. I mean, how long will this last? You know, I would like to think if we were doing an investment now, by the time we got around to a Series A, there'd be enough capital and we'd be prudent enough with the spend that we could get there. So I think, you know, I think on the other side, which is always interesting for the founders to think about, and kind of to Rich's point, is as a VC fund, like our number one job is to give back dollars to our investors. But the other part of our job is we actually have to do investments to do that. So we have 5 years to do those investments. So it's not as if we can sit on our hands for 10 years, like we have to invest. And so that's the good news for everybody on the call who's looking to raise money. You know, I think we can slow our pace and, you know, look at what we're going to invest in. But at some point in time, we do need to invest those dollars because that actually is our job. To Justin's point, you know, valuation is probably going to be a lot lower than it was in the past. But the reality is, you know, those valuations didn't work for us. We couldn't return capital to our LPs. And if we can't return capital to our LPs, then we don't have another fund. And at the end of the day, this is a full ecosystem. Like we have to return money to our LPs for us to have another fund. And if you're going to start another company where you need to raise more money, then you need funds. So in some ways, you know, we all do have to work together. And I think there should be enough upside for everybody to win.
Yeah, maybe to build on that, you know, again, there's two kinds of fundraisings. One is where you're going to take whatever terms and whatever money you can get because you don't have an alternatives. And in other cases, you have alternatives. So if you're in the first bucket, you know, ignore what I'm about to say. If you're in the second bucket and or you're just, you know, really trying to be mindful about, do I want to devote my life and every waking hour of my professional life to a company, which you're going to do if you're an entrepreneur, under a capital, you know, supply model that may not be ideal. And so to that end, a couple of words used to be really bad words. One was insider-led rounds, where, you know, the existing investors are the ones that give you the next round. That's become far more popular. It's about a third of all the rounds now. And there's a lot of reasons for that I don't need to get into, but it's less of a negative signal if it's an insider-led round, I think, by and large, than it used to be. The second thing that used to be a bad word was down round. And there's actually, you know, last year there's about 6% of rounds done were down rounds. That number will be higher. And for those who don't know, that's just when, you know, you raised at one price and your next round is slightly lower. It's not a great feeling. And you sometimes have employees that get pissed off. But let's be clear, it allows you to fight another day. And there is no evidence. This is really interesting. There's no evidence that doing a down round leads to a worse outcome. So if you live to fight another day by getting the down round, yes, you have a price adjustment, but you still go on to have exits in roughly the same amount and the same frequency as companies that have done nothing but up rounds. So point being, I always say there's two kinds of entrepreneurs, one that run out of money and ones that don't. And so all you want to be doing is optimizing for, not running out of money and then worrying about the alternatives from there.
Yeah, and that's a really good way to look at it, Rich. And just to give you a bit of the stats on that, so in our 3 years of data over, like I said, about 350 deals, up until the end of 2021, we had 88.2% of those deals in Canada were up rounds. So only 7.2% were down and about 5% were flat. And I think you're going to see a shift in that for sure. Obviously, that flat number is significantly higher, and the down number, people are, technically, and through a little bit of sleight of hand, right now there are companies that are avoiding the down round by structuring their deals. So they're bridging with non-priced bridges that have caps that look like they're flat, even though when you factor in the post-money calculation of the actual price per share on conversion, it's going to be down, and they're adding warrant coverage, which obviously effectively brings it down. And I think one of the important things for entrepreneurs in that market, because I agree with Rich, I don't think it necessarily matters from a long-term viability perspective if you're doing a down round, but what does matter is it becomes more complicated to understand your cap table. So I do think it's really important for founders who are raising, if you're doing bridges or even equity price rounds with kickers and stuff like that, you really have to dive in to a complex cap table to fully understand the dilutive impact, because you might, if you fixate on the enterprise value and is it flat, is it up, is it down, but you don't actually look at the impact of the round, I think it's hard to fully absorb what it is. Now, having said that, even if it is severely dilutive, to Rich's point, you have to do the deal you got to do to survive. And I'm still very surprised by, and there may be other lawyers on this call today, so they may feel the same way. I'm still very surprised when I act on the investor side of the table today with how much pushback some companies and their counsel are still giving on terms in this macro climate, where you're thinking, why are you negotiating terms on these deals? Why are you not like particularly today, time kills deals, right? And like today, if you've got a signed term sheet and it's either, middle of the fairway, or if it's got, decent terms and economics, I think people should just be marching towards completion. Doesn't mean you shouldn't be informed and understand the impact, but you really do have to get your deals done. So I agree with that sentiment, Rich, for sure.
Great. I might segue us. I think that was our first question, actually. We could have done the whole session on that first question. I want to dive a bit into some more specifics. So the title of this session was Stories from the Trenches. I think we've kind of dove into the trenches already a little bit. But I think that those type of stories from the experiences of the three of you are really helpful for our audience. People can take away kind of really good key learnings. So I wanted to kind of come to each of you and ask you to maybe share an experience navigating a really tough financial decision, or maybe a specific type of situation you found really challenging, and what factors you had to consider when handling it, and kind of what was the outcome. So I was hoping I could kind of get you guys to share some stories. And Amy, maybe it's something recent or from the past, but maybe I'll hear from you first.
Yeah, for sure. I think it kind of spills off of our last conversation of you have to do what you have to do. All of our companies, especially, coming through the last year, is how do we get to a point where we can last on the cash that we have? And a lot of those companies are looking at cuts. So they're doing cuts on their team, trying to, what we say, cut through the fat, but not through the muscle. Like, how lean can you get your team to still be able to support your customers and support your products? And then I'd say, some of them are even looking at their runway, and they're just not mature enough to be able to make it with the cash that they have on hand. So, is it time to also look at a dual track process? Should you start looking at some M&A? There's some big companies out there that have a lot of cash on their balance sheet that will do deals, in stock, maybe stock and cash. And could you see your product living off of with one of these bigger companies where that company could take your product and, you know, you could use their sales force or their distribution to be able to make your company very successful, even within a year. A lot of times when you look at these M&A deals, it's like, I have this product. If this other company sold it for me because it's kind of the right go-to-market strategy that they've built up over the years that I haven't had the ability to do yet, could I take that product and put it in with their company and they could make, you know, X millions of dollars within 12 months. And now all of a sudden you have a good negotiating power for what you could buy it, what they could buy your company for. And so could you, in the next 6 months, work on getting to profitable, but also have this dual track where you're having good conversations, you know, trying to get a competitive bid. So having more than 2 people looking at your company. And that's a lot on a founder. It's really hard just to, you know, wake up every day and try and move the needle in your company, but to have 2 hats, one moving your company forward and 2 also looking at M&A deals. But I think some of these companies are going to have to do that. And I think on the other side of it, it's like you could go and get some shares in this company. You could still grow your company to be a big one and do well. You can get an exit, you know, on your shoulder and go and look and doing something new in the next 2 or 3 years. So it's not a bad situation to be in. I think it's always worth the honest conversation of what should you be doing and what are your options. And right now, you know, optionality is really good. And if you have some cash in your bank, then you do have optionality. And so kind of look at all the options that you could go towards.
That's great. Justin, what are your thoughts on dual track? And then maybe you have a specific situation that you've encountered you wanted to share.
Yeah, sure. And I think the dual track approach, we are seeing it more and more, to Amy's point. So I think a lot of companies who are uncertain about their capacity to raise on the next cycle are trying to get out a bit ahead of that and think about looking at a strategy that will consider both an exit and or a financing, depending on what the market is telling them. So I think that's something we are certainly seeing more and more. And if you're doing that, to me, it's a lot about getting the right investment bankers or the right M&A advisors on your team to make sure they have the vertical expertise and understanding if their terms are in the market and how it's going to impact you. But we're definitely seeing more of that, Amy, for sure. You know, I think what I've seen in the last few months, which is rare and pretty unusual, is the actual retrading of term sheet, like settled financing terms at the 11th hour by investors. And, you know, that would have been unheard of, I think, over the last run and the cycle we've had from 2015 onwards. But we had a deal last year where they actually, it was in 2022, where the investor actually pulled the deal and dropped the price markedly and said, well, we're only going to close on this basis. And the challenge with that as a founder is that if you're running too close to cash out, one, you don't have any choice, you have no alternative, and so you just have to do the deal. But it also just severely impacts the relationship. Like you're sitting at the next board meeting and you're like the feelings from that kind of an event in your financing can permeate well beyond just the dilutive impact, but actually looking at sort of the relationships and so that to me was pretty incredible to see. I think when you think about what can you do there, like one is making sure you're really tight on your cash out date. And for those that have raised capital where you have a board that's monitoring your performance, it's great because you should have in every board deck that sort of, you know, slide that shows what your expected cash out date is, assuming no revenue growth or no revenue or whatever your assumptions are, really tracks carefully when you're literally out of cash. And then you have to really educate yourself on how long it's going to take you to get a deal done in this market. I was on a call, we have a bi-weekly call with our partner group in our firm across the country, and we basically just trade real-time intelligence and deal points. And, you know, today the general feeling was most of the companies we're talking to were saying you can be in conversations in Q2, but realistically, you're probably not in a good situation to raise capital, at least for the next quarter and a half, if not potentially far longer. But you know, being very realistic about that, and then looking at if we're running out of money next September, when is it time to really sort of hit the alarm bells in terms of how you're going to deal with that? Because if you're, we've had companies get down to basically making payroll. And of course, you then have literally zero leverage. And if dual track is an option, nobody wants to be in a situation where they're trying to negotiate a complex M&A deal when they have weeks of cash left. It's just not a situation you're going to want to find yourself in. So you have to be much farther looking when you're looking at your runway, and create more optionality. So you will see stuff you haven't seen before, and I think it's really important to have your head up on that.
Yeah, absolutely. Rich, I'm interested in your comment on the dual track approach as well as this retrading trend.
Yeah, I mean, look, I have a kind of motto I'm always sort of spouting off about, which is trying to make new mistakes, right? And after 20 years, I'm still making new mistakes. But one of the mistakes I've seen many times in the dual track, just to address that really quickly, is companies pollute the process both ways. So they're out fundraising, they get an M&A offer or vice versa, and they kind of let both sides know what's going on. And if one or the other falls through, the other side goes, well, wait a minute, what did I miss? So in most recent case, it was an M&A deal for a lot of money, and the buyer walked at the 11th hour because of the market, and couldn't get the board to agree. And all of a sudden their fundraising fell apart because they couldn't, the investors were like kind of had gone tools down because they thought, well, this is going to get sold. So just be mindful of that. Again, it's a bit of a luxury problem in a lot of cases, but you just want to make sure your process is, your data rooms, like everything is as clear and distinct as possible. The other more general thing I would say, the mistake I see all the time is companies wait too long and they view fundraising as a transaction. They view it as like, I'm going to come in your office and 6 weeks later, you're going to give me a term sheet and be done. And the reality is more and more, and the leverage has shifted back to the investors, is it's a relationship, and it's like a year, could be 2, even at the earliest stages. Like for me, the biggest factor I look at is what's the rate of learning of the entrepreneur? How fast do they learn? It doesn't matter about what. Because they don't know the answers, and the product will change and the market will change and everything's going to change. But how fast do you learn? Well, you don't know that over a 1 month, 3 month courtship. It takes years. So I think for a lot of investors, they're saying, hey, let's look at the story. Let's talk again. Let's get an update. Send quarterly updates. By the way, that's a great tool to keep people abreast of kind of what's going on for you. The last thing I would see all the time, they optimize for valuation. There's an old expression in venture, tell me the price, I'll tell you the terms. The terms that can do you way more damage than the price. So don't optimize just for price. And a lot of people, when money was free up until 6-9 months ago, were taking on things like venture debt or revenue-based financing deals or things. Guess what? That money ain't free. So not only is your interest payment and things like that going to hurt you more, but here's the big kicker. People like Amy or myself who come along and you've got a $5 million venture debt facility out with somebody, and don't get me wrong, venture debt firms do great work and they're a part of the ecosystem. But if you're saying to me, hey, put $10 million into my company, I'm going to use 5 of it to repay this guy over here, that's not a great deal. That's not a productive use of capital in my estimation. So you're going to see a lot of fights. Justin's going to have a litigation group that's going to be very busy between investors, entrepreneurs, and debt holders who are going like this. I think that's going to be a real big story going forward.
Let's keep an eye on the time. I'm going to skip ahead. We touched on this a little bit earlier, but I think it's a good topic to dive into. Just kind of, if you guys could share any further advice on how companies can kind of manage that burn and extend their runway. So, do you guys have any kind of practical advice for some of the founders or entrepreneurs on the call today? And if you don't mind, Amy, I'll come to you first on this one again. Rich, I keep on putting you last just for fun.
That's appropriate. That's fine.
Save the best for last, right?
Yeah.
I mean, a few things that we're looking at, especially as we approve budgets for 2023. In the past, a lot of times you'd see a lot of spend starting Q1. So hire as many people as you need to be able to make your plan for 2023. And then all the revenue is going to come in Q4. And I'd say like those plans are not getting approved. So it's like in Q1, what are the milestones you need to hit? If you hit them in Q1, then the board will okay a little more spend in Q2. And if you hit those milestones in Q2, a little bit more will come in Q3. And so you'll see a lot more of this gated budget. So you can't do all your hiring in Q1. You want to hire 10 people, you can hire 2. And then what are you going to hit in once you get to the end of Q1, and then I'll let you hire 2 more people, right? So there's a lot more gating that you're going to see. The other side of it, which is kind of nice, is in the past, a lot of people think about the rule of 40. And so we continue to think about the rule of 40. The difference is, 2 years ago, people were, growing the rule of 40, just for people who don't know what it is. It's kind of your revenue growth year over year, and then your EBITDA, your profitability margin. When you add those together, they have to add to 40. And so if you grow 300%, then you can spend negative 260% on your profit line down below. I think those days are over because you can't control revenue growth. You're not sitting in a market where you're going to grow 300%. And so the only thing you control is your cost. So how do you get to profitable, or how do you have an EBITDA that is 40 and then show, 40% growth, or your break even and your 40% growth, so that you have that 40 rule, but you're changing, more or less like how you're thinking about that rule of 40, because you can control your costs, but you can't control your revenue. You can't kind of put your head in the sand and hope that revenue is going to come.
Helpful, Amy. Justin, what are your thoughts?
Well, I mean, what we see mostly, I think Amy covered most of the ground there. What we see in where we're involved, both from an advisory perspective and that it's sort of around the boardroom table, is a lot of conversations about staffing, obviously, and that's what's making the headlines too, right? But the risks that Amy talked about, and the general philosophy being, unfortunately, cut probably deeper than you think you need to. And be really diligent and fairly militant about it in terms of your decision making. So that, I think, is a big one. But also other things, just being careful about your cost structure and looking at other fixed costs and your facilities and other things that you are going to commit to, and taking a little bit more care. And as a founder, I'd say also utilize your investors and your board in that regard. For a lot of founders, particularly if you're younger and maybe haven't lived through different cycles, it's like you have people on your cap table that can be resources to you in terms of understanding how to operate in a different environment, what choices to make, and where to cut and where to build. And so making sure that, one, you're reporting frequently to people, and that you're open about your performance, and you're not showing up at your quarterly board meeting with massive surprises on the financial performance side, because that certainly does not build the goodwill that will promote bridge financing. And so that's been a big mistake I've seen people make, is sort of come to the table with really bad news being delivered without any regularity. And I think you've just got to be transparent and take the resources you can get from the Riches and the Amy's of the world to help you think about how to spend.
Right. And yeah, I'm sure it's a bit of a balance, like decreasing costs, but not slowing your growth, so that you're not.
And that's something for actually a question, I guess, for Rich and Amy too. Like, people worry because it's been years of being pounded into you. And Amy, you covered this a little bit, but you have to show growth, and you have to show a venture scale business and all these things. So how do you walk that line? And when do you walk that line, I think, is a tough question.
I think people are adjusting those grow at all costs kind of, mantras. Not to suggest, to your point, you don't want a venture return. So something growing 2 or 3% a year isn't going to generate venture returns. But I think the 100%, triple, double, maybe sort of softening. What I see investors looking at more, and Amy, you may see the same, is like, what's the quality of revenue? Meaning, like, are you adding revenue with unprofitable customers? Are you adding revenue from net new customers? But is your, your retention ratio, like how customers are expanding, how is that relationship going? And one counterintuitive way to extend your runway, and I'm aware of, it sounds goofy, but you've got to cut costs, but the middle, one interesting thing in the middle that I've seen some companies do is they increase their prices. So it tells you two things. One, it tells you how much the customer actually values you. If you are in that quadrant where they need you, they want you, they like you, 10, 20, 25% price increases, generally speaking, they can take it. And if you have enough customers, if you have a couple of $1 million in revenue or even $1 million in revenue, guess what? You've probably just generated anywhere between 2 to 6, 8 months of additional cash runway. So it's not something a lot of companies feel is right in a macro climate like that, but in some cases it actually works really well.
Okay, well, just keeping an eye on time, I have one question from the audience that I'll bring to the three of you, and then I've got one to close us out. So the question from the audience is, what does ESG investment look like in this environment? Change is desperately needed, but are investors increasingly betting on safety? Rich, I might come to you, and then happy to have Amy and Justin weigh in.
Yeah, I mean, listen, I call it impact, call it ESG, call it what have you. I think it's the curve has been exponential and up to the right in terms of interest, demand, capital placed, sophistication of managers. Every aspect of it is encouragingly going the right way. And I don't think that's going to change with the climate. I'm involved. I mentioned Canadian Tire. It's a consortium of retail, large companies in Canada that are maniacally focused on how to improve ESG footprints. And so I've seen that in TELUS where I was. I've seen it in the retail space, in the manufacturing. What it means, how you do it, at what pace, how you report on it. Everybody's kind of walking around like in a daze, and the consultants are feasting on big companies, giving them all these playbooks. But the reality is every board meeting, every shareholder call, every executive briefing has an ESG, sustainability, climate impact lens to it, which is exactly as it should be. And I think that's going to keep going. I don't see that market kind of going anywhere but up.
Yeah, I'd agree with that. I also think, before, if we're talking about the before and after, I think ESG is important on both sides. And I think returns are important on both sides. And they always were. And so you need both. So I don't think it changes there. I don't think you stop doing one and the other one increases, or you stop doing the other and the other decrease. Like I think they work and play well together. I think what doesn't work is kind of the past of, huge valuations. You had a ton of private equity firms just giving tons of money and growing at all cost and doing everything you can. Well, those big private equity firms are underwater. Their returns are -40, -60, -70. Like, where do you think those investors are going? They're probably leaving that fund and going to start a new fund. So I just, that's a little off of the ESG topic, but it's one of those things that it still has to work on both sides of the equation. And I think ESG and investment return still have to play well together.
Yeah, and I would just add that I do think if you look at clean tech specifically and ag, I think those are two areas. I know those are very broad categories, but two areas where in Canada we have a pretty good pool of investors. Even locally, we've got Pangea in the material space. Evoke is doing a lot of clean tech and oil and gas innovation. BDC is very active, and there's lots of capital to be deployed that is being deployed, and you're seeing some good deals getting done. And so I think a lot of the strategics, CVCs like the Chevron Ventures and Shell Ventures, and even their non-venture arms are doing more and more active deal works as corporates, and they can sometimes be less valuation sensitive if there's a strategic imperative. So I think from that perspective, it's certainly an area where we've seen relatively robust deal flow.
I have one final question, and it's just kind of just to come to each of you with some final words of wisdom. I know I really appreciated the three of you. You're real experts in your field, and it's amazing to have you here to share that with our members. So kind of any final kind of words of advice for founders or entrepreneurs on the call who might be just starting out and have big ambitions? Can you share some final words of wisdom, maybe some positive thoughts for the year ahead? And I'll come to Justin first on this one.
Yeah, sure. I think Rich alluded to it in one of his comments. Now is not a bad time to start a company, because I think if you're building from scratch, you don't have commitments yet that you have to satisfy on how you're running your business and what you're paying people and what your capital costs are. Like, you can build a business into this current macro climate And there are lots of seed and Series A funds out there that have to spend their money, as Amy said, and so if you can, it's a good time to build a good company in the early stages. I also think, having done this for 20 years, I lived through I started around 2000, so I saw the remnants of and experienced the tail end of the big bubble in 2000, 2001. Lived through the financial crisis in 2008, and I can tell you through that 22 years, there's ups and downs, but there have always been hundreds and thousands of startups, and there's always been people investing in them, and so I think we just lived through an incredible time, and now it's just going to be a little bit harder, but I think it's still a great time if you're an entrepreneur to go out and build something fun and remarkable. So I think it's just redefining how you expect the first couple of years to go, probably is what I'd say.
Interesting. Amy.
Yeah, I think the companies who can make it through this, or who are starting this, I think you'll be the stronger companies, because I think you'll really know your business. And, I think you'll structure your business so that you can grow on what you have. So I think it's actually a positive. I think it's going to be hard, but even in the days where you were raising lots of money and spending lots of money, it's still hard. But I think the ones who can really kind of double down and work with what they have and get through this, I think they'll be stronger for it.
Great. No surprise. I'm coming to you, Rich. Last word.
Yeah, I mean, I was reminded of that quote, like the Winston Churchill quote, right? Democracy is the worst form of government other than all the others. Venture capital is the worst way to finance a company. I mean, I love it. I think it works for a lot of companies, but it doesn't work for everybody. And I think what you need to do if you're early in your sort of growth stage is ask yourself, are you better served by having a lifestyle business? Are you better served by just raising some bank financing? Because if you strap yourself in for the venture route, you're going to have people pushing and prodding and poking, and sure, they're going to support you where they can, and they're going to challenge you, hopefully, to be better. But it's a horrible way to make a living. I mean, it really sucks if what you want is a nice business with a relaxed work-life balance and all those things. So I think for a lot of people, they kind of get myopic and they go, I need a venture relationship, and they really don't. Most of the people I know who've made a lot of money in this town didn't do it the venture route. So just be mindful and be prepared if that's the route you want to go, but there's lots of other paths to prosperity.